RBI should cut rates.
Rate cut is important.
Rates too high.
Rate cut is imminent.
RBI must cut rates.
The clamour for a rate cut hasn't been louder, and Governor Rajan did relent by a 25 basis point cut in repo rate, which is now down to 6.5%. But it seems the governor has moved beyond a rate cut to do his bit to boost growth. And boosting liquidity is a big area of focus for him. In a huge change of stance, the RBI has decided to bring down liquidity deficit to nearly zero, which is a big departure from its earlier wisdom of creating a liquidity shortage.
Given the various measures that have been taken to fix the policy rate at close to the repo rate through these overnight instruments, the need to maintain the system in liquidity deficit no longer is there. Therefore, on a review of how far we had come with these overnight instruments, we decided that it was no longer necessary to maintain that significant liquidity deficit. We could move towards a more neutral position, which is what was announced today.
In some more measures aimed at fueling liquidity, the RBI has also reduced daily maintenance of CRR to 90% from 95%. RBI has narrowed the policy rate corridor from plus minus 100 basis points to plus minus 50 basis points. Marginal standing facility rate has also been reduced by 75 basis points to 7%, and reverse repo has been hiked by 25 basis points to 6%.
The effects of the liquidity measures will also help transmission, because banks have continuously been saying it's because of liquidity tightness that we can't transmit. Now we've given them enough liquidity, they have the ability to transmit even more.
Commending the fiscal consolidation roadmap of New Delhi, the governor is confident of growth levels at 7.6% and inflation at 5% by the end of this fiscal. But recent levels of rise in oil prices and erratic monsoon are pockets of concern. It's actually the 7-pay panel that the banking regulator is losing sleep over. The RBI expects it to stoke inflation by 1 to 1.5%. The repo rate of 6% is the lowest in 5 years, and economists view this as an accommodative policy. One thing is certain, with dramatic reduction in inflation unlikely to happen, liquidity measures can push down the market rate significantly. The ball is certainly in the court of India's lenders. Neha Bothra and Tanya Bharadwaj, ET Now, Mumbai.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.